Hello and welcome to F5 for Kids, a podcast about guiding your kids on the path to financial independence and extraordinary lives. I'm your host, Dominic DeLaquil. Our guests today are father and son Roger and Nate Conrad. Roger is an investment advisor with a focus on dividend strategies, energy investing, and long game thinking. Nate builds custom AI co-pilots to assist entrepreneurs and small business founders. They have a father-son business partnership where Nate's business supports Roger's mission on the tech and media side. So we're going to talk about all that and more today. So Roger, Nate, welcome and thanks for coming on the show.
Thanks for having us.
Yeah, great to be here.
So let's start, I guess, where I usually start. Roger, let's start with what you learned about money when you were growing up.
Well, I guess like for that, my dad was kind of a model. He was a college professor. So college professors, particularly back in those days, didn't make a whole lot of money, but he did really learn how to manage what he was doing by just being very methodical. And, that's worth talking about for a long time. But I think, just kind of the end result, my mom, he's been gone about 12 years. And my mom basically lives on maybe 4 times the income that they had when we were growing up. So just putting things in place and letting them grow and being very patient and steady, I think that's pretty much informed my style. And when I started doing this professionally, and I came to it kind of in an odd way, I'm an anthropology major. I did go to business school after that, but that's been my strategy, my style, and I continue to do it after, I guess, hard to believe, like 40 years I've been doing this.
Yeah. Well, first I just want to say that I think an anthropology major is actually a really cool major because it's very broad. Like my original degree before I did physical therapy was an English Lit degree, which again I think is very broad and just you learn how to think and communicate and all kinds of things. And I know that anthropology, although different, has a lot of similar qualities, at least in my experience with the anthropology stuff that I did. So I just think that's cool that you have that background. But with your dad, now did you talk with him about money when you were younger? Did he explain what he was doing, or was it just things you picked up on kind of over time?
He would explain things, but being a kid, I have a limited attention span for a lot of
Sure.
that. He was a depression kid, so he grew up and they moved around, and my grandfather had businesses that went, did well, went bust. So I think what his whole thing was just put a plan in place, be steady about it, and don't be emotional about it. But yeah, a lot of things I just kind of absorbed watching him do things.
Yeah. Yeah. I want to touch on that later, that the idea of not being sort of emotional about your money. So I'm glad you mentioned that because I want to make sure we touch on that a little bit later. Nate, so, growing up with a father who was then involved in investing and giving investment advice to others, how was that for you when you were a kid?
Well, I definitely heard a lot about utility companies and energy companies, way more than the average kid. I think the main message that I got, I think it's really similar to what you were saying, where I don't remember specific principles other than maybe, first of all, the idea of being active and being intentional about it and not just handing over the reins to like an algorithm or, software. Because growing up, there were all these apps, and there are even more now than ever, and they're kind of promising a totally passive, hands-free experience. Acorn, you kind of chip away at it, you automatically connect it to your bank accounts, and then you never have to do any thinking of your own. But I think with the close proximity that I had to someone who was very actively managing investments really impressed upon me how great it is to, have that extra level of control and to really consider it something you should take on actively. So I've done that. Yeah.
No, I think that's good. I think one of the things that's come up in my conversations with people is sometimes if you haven't grown up in an environment where money or investing in particular was something that you talked about, people a lot of times don't feel comfortable with it and they're intimidated by it. And so I think that's where there's a draw to just things being simple and kind of automatic and done for you because people don't want to think about it. And then at least then they're doing something. So that's better than nothing. So I think it's interesting that both of you, it sounds like, right? Just because of your, at least some conversations about money when you were both kids just gave you a better comfort level with that. And I think that's so important for any of the listeners. The more that you can talk with your kids about money, the more it's just, even if it seems like they're not listening or they don't really have much of an interest, it's still going to set them up for when they get older to not, at the very least, to not be so intimidated by it, I hope.
I mean, I hope I definitely have proceeded that way, with my own life and dealing with my own kids. I mean, at one time I had a job that kept me away from home for a long time, and I could actually go back and look at video clips that the timestamp tells me I was clearly not there,
Mm.
kind of late in the evening. I was like, but I have been able to be around them and try to, make those kinds of impressions and tell them about things I think are important. And I think, physical health is very important, mental health, but also financial health. And to me, I listen to a lot of people talking about, well, I can't deal with anything, financial, and it's very complex and everything. But they won't do the same thing, like say with their medical health. They'll go and they'll actually do some research. And I
Yeah.
think they're both like just hugely important for people to really take control of those things, because we do have a lot of advantages out there. True, there's a lot of good financial information. We do have the best investment markets in the world. I think the most transparent for all their problems. And it's all out there to look at, but you've got to be the one to go and take charge and take a look at it. So if I ever imparted anything to you, I hopefully I do think that I did do that. So
Yeah, can confirm.
Yeah, you bring up a good point there, because I think, and there was someone else I talked to a while back, and he had a great analogy for that. He's like, I talk to people and they can go, they can tell you all sorts of things about sports, or they really go deep on entertainment. And he goes, so you have the capacity to go deep on stuff. You're just not doing it with your money. Right. So kind of your analogy,
right.
well, people sometimes they've got, they're concerned about their health. They'll go deep on that. So you've got the capacity. You just need to apply it to your finances. And I agree. I agree completely. So Roger, then let's transition into talking about your investment approach, because it's based more on a dividend strategy than it is on a just hold stocks and let them sort of grow in value, and then you'll reap the benefits of that way down the line. So talk about dividend investing, how it's different, and what you see as some of the advantages there.
Well, I think advantage number one, the bird in the hand versus the two in the bush thing. A dividend is a pretty sure part of your return. So if you own an investment that's paying you 6% on your purchase price, you're ahead 6% before anything else happens. But my dividend strategy is a little bit different, I think, than some of the others I see. I don't necessarily chase the highest yield. In fact, sometimes I'll look at a very high yielding company and I'll want to buy it, but that's not the reason I'm going after it. What I really want to have is sustainability. I want to have a business that's growing over a period of time and, growing their earnings, growing their dividend, doing something that is going to make them continue to grow, which is one reason I really like utilities. That's probably the surest example I can think of, but there are others as well. But those are the types of companies I like. So I can get a big yield, but I'm going to get a yield that's growing. It's going to keep me ahead of inflation in terms of income, and it's going to give me capital growth because that dividend is going to grow along behind it. And when we do come into downturns, and I know this is something people need to think about with investing, how do you respond when the value of your portfolio is declining? It's not always going up. Dividends can really help your psyche a lot in those times, because you can collect more dividends. The dividend's going to keep going if you've chosen your companies well. Now, in a downturn, a company that has a massive yield, they may have to stop paying it. They may have too much debt. They may not. The revenue may drop. Lots of different reasons, but that's the kind of income investing that I like to do. Again, see the bird in the hand, but also we're going to get capital growth. We're going to get dividend growth because the business we're buying into is going to be growing, and it's going to be a sustainable kind of growth over a long period of time. And so, I mean, just to keep going, not keep going on, but I've owned a lot of things called dividend reinvestment plans. And these are just basically plans set up by companies that will reinvest your dividends for you instead of paying them to you. And over time, that money buys more stock, and I've got a couple of these things. Honestly, I make more money in annual dividends than the initial investment. So they're a very effective wealth building tool. They're not something a lot of people think of, but that's another thing that, when you get a downturn, a dividend reinvestment plan is going to buy you more stock.
Yeah,
So
right.
you might, yeah,
So you can set that up automatically. So the dividends that they're paying you, they just automatically reinvest in whatever that stock is and buy more. So if you're younger, for example, and you're trying to sort of grow your portfolio as you're planning for retirement at whatever age that's going to be, then you would take those dividends anyway if you're using a dividend investment strategy, and you'd still be using those to reinvest in buying more stocks, right?
absolutely.
So if I'm understanding you right, there are two ways to potentially look at that. One is, I like this company and I think it's sustainable. I want to stay with them long term, and I want to talk about sustainability in a second, but I'm going to set this up so it automatically just reinvests and buys more of these stocks when I get those dividends. Or you could take dividends from another stock and say, okay, I like this stock, but there are some other things I want to buy. I'm going to take these dividends and I'm going to buy these other stocks that I've identified that I think are worthwhile. And that's how you still continue to grow your overall portfolio. Is that my understanding that right?
Absolutely. Yeah. You're just reinvesting you're putting compound interest to work for you.
Yeah. Yeah. Right. Right. Yeah. Because each bit that you reinvest, right, then you get more dividends because you've got more in there, and then you just keep that cycle going. Yeah. Exactly.
Yeah.
So then let's talk about. I like this idea of sustainability, but how do you identify a company that you think is going to be sustainable and has a good, I don't know what the word is, but they have an overall picture that makes you think, oh, this is a strong company to invest in, and they're going to serve me well over time. How do you evaluate that?
Well, I have I basically look for five things in companies. First off, I want, the dividend strategy to be sustainable. So the company to, I want to not necessarily a company that just pays a whole bunch at one time. There are things called special dividends, but I want that dividend paying strategy to be sustainable. I want revenue to be reliable. And what I mean by that is when you have a downturn, does the revenue drop off a cliff? Does it, or is it very steady? Again, that's number two. Number three, regulation, legal matters. They're a big part of everything in our culture and our society, and certainly hugely important to investing. If a company's regulated, I want it to be, on good terms with the people regulating. And I don't really want, if there is a big legal issue, I want to know about it. But I do want to know about that kind of thing. And then, balance sheet, and that what I focus on kind of varies a little bit depending on the environment, but I generally like to see a company that has, you know, can access debt capital pretty cheaply. So it has an investment grade rating, which would be triple B or higher. Certainly not a foolproof system. And that's a whole different podcast, basically. But it does mean that they pay less for issuing bonds. And I want to see companies that maybe don't have a whole lot of refinancing needs all at once. So things like that, a lot of different, and then operating efficiency. And that's very much a company and sector specific kind of thing. But for example, a company that say owned a bunch of nuclear power plants, I'd want to see that company running those plants pretty consistently without like a lot of safety concerns. A high rate of which right now would be, probably the low 90% range of its capacity. So things like a lot of different things, but you get the big picture of it. We're just basically looking for companies that can take a punch. If things aren't going so well at a certain point in time, and we want them to be kind of on a track where they invest more money, they grow, and then we grow, our income and our capital grows with them.
So and one of the things, like, because you mentioned like high yield, so some dividend stocks are really sort of high yielding, but they tend to be more leveraged, right? So they've got a fair amount of debt, and that's how they're producing those high yields. And that's something that you look for to make sure that you're not, because then that can be riskier. Is that my understanding that right? So it's not that you don't you avoid high yields, but that's not the biggest thing that's attracting you. You want this stability, so these stocks are going to be solid over time, even if there are downturns in the economy. Am I understanding that right?
Yeah, absolutely. A good example of, sometimes the market misprices, I believe. So natural gas pipeline companies, for example, they've had yields of 9, 10, 11% recently, but they've been growing the dividend. So, and they've been cutting debt at the same time. So the market is pricing in a lot of risk, but it's wasn't necessarily the case. So those are the kinds of things that attract me. But on the other hand, there have been a lot of telephone companies that have really high dividends, but their revenue's been eroding, and so people have been focused on that high yield, and they're like, well, the earnings covering it or whatever. They're just attracted to the high yield. They're like, well, they're going to maintain it, aren't they? But the company is shrinking, so they can't sustain it. So yeah, that's exactly right. I love high yield. I love a high yield again because it gets us ahead of the game when we buy it, the bird in the hand. But if it's not sustainable, then it's really not worth the paper it's printed on. It's not
Yeah.
going to last.
Yeah, so company stability and therefore sustainability is a more important criteria for you than strictly just a high yield.
Yeah, I think in terms of the strategies that I like, which again, I like the dividend, but I also want my capital to grow. I
Yeah.
want to keep up with inflation. And that's going to happen if a company is growing. If it has things like pricing power, it can pass on its costs to other, if it has a strong balance sheet, things that we've been talking about, signs of sustainability. But yeah, you have to have these cornerstones, and that's really the surest way to go about it, particularly if you don't want to spend all your time, looking at where a stock price is. If you're confident in a company being able to take a punch in a bad time, then you're not going to mind so much when the stock price goes down. You won't like it. I hate it when stocks I own go down or I
Yeah.
recommend go down. I mean, that's but again, I have the confidence to hold them because I actually know what it is that I'm buying.
Yeah, yeah. Well, I mean, every company, has its ups and downs, and I think someone described it once as, the market and companies, I think they breathe, right? So there's a natural sort of
Right.
ebb and flow, but then I think that still gets back to and it really kind of emphasizes to me your idea of stability. If it's a strong organization, it's well run, their balance sheet is solid, right? They've been managing their finances well, they're going to be able to continue to thrive even when they have a little bit of a dip. And oftentimes, right, then they can come out of those things stronger if they're a solid company. I guess my question though is, so that all makes sense what you're saying, but my next question is, how do you find that information to know those things about a company that you're considering investing in?
Well, there is a lot of publicly available information. I mean, there are definitely a lot of opinion sources that you can consult. And that's basically what our company is. But there's a lot of information that companies put out, and they're legally obligated for it to be accurate. So, like anything on the SEC website, you can look at, and they spend a lot of time. Boards will spend a lot of time making sure that the information is in there that they can't be sued on. And uh, we spent a lot of time on the board trying to make sure they were doing things right. So, I mean, there's definitely an ethos, I think, in most places to have this information be accurate. So I think as an investor, you can go in there, find your companies from wherever, right? Some company that interests you, and you can go in there and check up on it on these various criteria. There's nothing wrong with asking somebody's opinion and taking the opinion of an advisor that you trust. But, when you're starting out, I think it's just invaluable to try to, uh, you know, figure out, first off, look at some companies and then just make your own mind up about them and make some bets based
Yeah.
on that.
Yeah. Okay. And so get as much information as you can about how they. So you look back sort of at their history and see how they performed over a certain period of time, then to get a sense of if they seem like they're stable and they're going to be sustainable.
Yeah, that's yes. In a nutshell, yeah. I mean, so I use a service called right now. I used to use a service called Bloomberg, which was extremely extensive and, had a lot of things that I didn't need. Now I use a service that's a lot cheaper called Koifin, and it provides a whole lot of information that I can access very quickly. So there are a lot of services people can pay for. And if you spend a lot of time with your investment, it might make sense to take a look at some of them. Some of them do charting, so you can look at the price thing. I look a lot at transcripts of what companies say in their guidance calls. So every 3 months, a company will announce earnings for the quarter, and then they'll have a conference call about it. And first part of it is they are making a presentation, right? They're saying, here's how things were and so on. And then there's questions, and those are really interesting as well. And one of the things that I really look for in those is I want to see what they're saying now and then compare it to what they said 3 months ago and compare that to what they said 6 months ago. Now, again, I'm doing this for a living, so I have the time to do that, and other people have other jobs and so on. But that's really fascinating. If you can find a management team that is able to just say, here's what we think things are going to be like, and then they look at it like 6 months later, things are better or they're the same, or if things aren't as good, there's a good reason for that, then I think that is a pretty good sign that these people have things together. We talked about anthropology and so on. I mean, it's all about people, right? If you can find a company that if they're basically able to sit down, say, here's how our business is doing, and they have a grip on what all the various aspects are and the challenges they face and all that, and they can convey that to you as an investor, I like that a lot. And, I respect that a lot. If a company is not able to do that, I think probably you don't want to, and a lot of companies will do these quarterly reports, and it'll just be hype, 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 hype.
Yeah. No, that's actually makes a lot of sense to me, right? So if you can look at sort of what they've said and what they were projecting and go back and look at that over time and then see the results and kind of match those up, then I think that makes sense that then that can give you, hopefully a pretty good idea of, oh, right, do the people running this company, are they trying to be realistic and they're serious and they're not trying to do hype, they're just trying to do a good job, and they seem, and then their results seem consistent with what they're saying, then this is something I might be more interested in, and you can dig further versus like, well, because you can get a sense from things oftentimes like this just seems like it's fluff, and then if the results aren't matching up or they're too up and down or they're inconsistent, then that might be, maybe I'll focus my efforts somewhere else. So
Yeah,
I think that's good.
Yeah, absolutely. I mean, numbers tell a story,
Sure.
right? But I think often they obfuscate. I think if people just get too focused, oh, this company is all about this number and this number, you're going to miss the big picture of what's going on. And, there are a lot people losing a lot of money by just relying on numbers and not maybe thinking a little bit more.
Yeah. Yeah. Nate, do you have anything you want to add to any of that, just from your perspective? I mean, you don't live in that world in the same way that Roger does, but do you have any thoughts to add to that?
Yeah, I guess one thing that's kind of dawned on me from, talking to my dad about all this kind of stuff for a while is that it's not quite such a binary where you're choosing between, being active and therefore having to spend your whole life looking at investments, or versus on the other hand, totally surrendering control to an algorithm and hoping that when you open the app a year later, you're doing better than you were a year before. You actually can, take control of like a few key areas, and then to some extent you can set it on its own sort of automated course, like with the dividend reinvestment plans, the drips, right? Like you sort of do your homework on the companies, make sure that you like the companies and you understand what you're investing in. And then there's these programs that will make your money compound over time. And so you can kind of check in here and there. And it's maybe going to be a little more time than if you were completely passive and not touching your investments at all. But by the other side of the coin, you're probably going to be making more money like faster, because you're not just doing you're not tracking averages and doing what everyone else is doing, right? You're putting in a little more effort than that. So I think there's like this really cool sweet spot that I think a lot of what my dad does kind of gets at.
Yeah, no, I'm glad you brought that up. That's a good point, because I think like with anything, right? Whether it's health or you're eating or your finances, right? The picture for each person is always a little bit different, how they piece that puzzle together. So you bring up a great point that it's not a binary, either you're it's all totally you and you're spending a bunch of time doing this, which some people are just not going to want to do or don't feel like they have the time to do, or being totally passive. There's a whole range in between, and each person can sort of try to find, it takes a little bit of effort, right? But then they can find their sweet spot in there to get the best results for them, just based on how much time they want to spend, what they're comfortable with, all that sort of stuff. And also, right, that changes over time, because as you become more comfortable, and then you can continue to learn more, and then you understand things better, you can hopefully you can ascertain things maybe a little bit more quickly and decide more easily whether you think that's a good stock to invest in or not, and just kind of keep moving your whole process forward. So I think that's cool. That's a good way to look at it.
Yeah, thanks.
Today's episode is sponsored by Money Mavericks. Parents, if you've ever thought, I wish my kid could learn about money without all the stress and confusion that I went through, you're going to love this. Money Mavericks is a video game, but it's not like the others. It's a fast-paced, choose-your-own-path financial adventure that teaches kids how to make smart money decisions before they have to face them in real life. It's built on over a decade of insights from 100-plus millionaire interviews, and it's tested by certified financial accountability coaches using 66 of the most common real-life money situations. And here's what makes it different. It doesn't just teach dollars and cents. It helps kids develop the mindset, habits, and behaviors behind true wealth. Financially, yes, but also in their relationships, career, and their health. Give your child a head start towards freedom, confidence, and a life they're proud to build. Head to www.accountable.network to learn more and grab a free copy of Money Mavericks today, because your kid's future is worth more than just a high score. So let's talk about downturns. And I actually, Roger, and I want to mention this, right? So you've got a Substack, right? You've got a newsletter, Dividends, right, with Roger Conrad, that I was actually just reading this morning, because I had gotten my email from Substack, and I thought, oh, there's one from Roger. Great. I'll have a look at that. And you were talking about downturns a little bit in there. I mean, there were a number of things you were talking about, but one of the things you mentioned, right, is just having done better than the market over various different downturns. And so let's talk about downturns, how dividend investing can be helpful with that, and also this idea of detaching your emotions from your money, because I'm assuming that plays into the downturn thing in a significant way. So talk about all that.
Sure. I mean, every time there's a downturn in the stock market, and there's different definitions for that. 10% decline in the S&P, 20% decline in the S&P. There's always a flood of people saying, "Oh, we called that, and you should have listened to us," and whatever. And next time, but I don't think it's so much important to. It's obviously nice if the market declines and you see some of the signs beforehand. And I think there are some now, one just being we're so concentrated in the weighted S&P 500 in just 8 names, just 8 big tech stocks are about 35% of that index. And it's unprecedented. I mean, the last time we were kind of around there was around 2000. So, I mean, that makes me a little more cautious. It makes me want to hold a little more kind of cash type things, like the Vanguard Federal Money Market Fund yields around 4%. That's pretty good. It's not as good as some of the stocks, a lot of the stocks I have, but it's okay to have something in there. And I know that when things come down, that it'll be there for me to invest. But you have to be invested in the market. And if you spend all your time looking for, when the next downturn is going to be, you're going to be left out of a lot of the best rallies. You're going to lose a lot of the best returns in the market. So what's important when you go into one is what kind of stocks you have. And, we've talked a lot about these, steady kind of slow and steady wins the race kind of stocks, real solid kind of companies. They're going to go down with everything else if the sell-off is severe enough. I mean, you're not going to be completely spared. 2008, really good example. And we've had lesser examples, shorter-lived kind of downturns, like when the pandemic hit, right, in February, March 2020, I mean, those types of things. Though the companies that were solid, they went down less, and you could be more confident in them. And they came up. They were the first ones to come back up. So it's what you own. That's having some a little bit, maybe recognize some of the signs and have a little bit of cash. But I think more importantly, having good companies and then just, kind of being able to detach a little bit. And I think, when things are going down and just recognizing the fact that the stock market has been there are big corrections every so often. There's some people say a certain number of years or whatever. I think they're just going to happen just like it's going to rain every now and then, right? So, do you have a good umbrella? Are you camping out with no tent or something, right?
Hmm.
So, yeah, just building a good portfolio is 99% of it. Keeping your head, while it's going on. Maybe you're going to buy a few more things. In our paid services, we have things called dream buys. We started these things with some of the services. Basically, the idea is these are prices that if the stock reaches, these have been historically low points in terms of the value of the business relative to the stock price. And if you buy at those prices, historically, you've had some pretty massive gains coming out. So that's another thing to play a little bit of offense as you're going into it. So that's more or less, I guess, the downturn strategy.
Yeah. Okay. Well, I mean, but that's good to know. I think two things stand out to me there, which is, these more stable companies and this dividend strategy, they're going to go down less when there is a big major downturn, right? And then they come back up sooner. And your idea of, well, if you're kind of worried about some things going on, you can hold some money in cash where you're still earning some interest, right? That 4% and that. And
Right.
there are also, you can find even just some high yield savings accounts right now. Like I've got a high yield savings account I think it's still 4.5% or so, right? I mean, so there are ways, so you're earning a little bit, but then you can also then, when there is a downturn, then you can buy at a bargain, right? And that's where you can, then when things do come back up, you can really then kind of jumpstart that wealth building that we were talking about sort of early on. So,
Absolutely.
but then again, those are all non-emotional decisions. You're just trying to be as objective about it as you can, understand what's happening, and make as best you can smart decisions along the way. So,
Yeah, and which is hard to do. I mean, that's we talk about it now in a time of relative prosperity, I guess, in the stock market. But when these things have happened, 2008, I'll never forget, early 2009, like March 2009, I guess was the bottom, and people were talking about they wanted to sell everything because they were worried about what President Obama might do and so on and so forth. And it turned out, of course, the subsequent 8 years were fantastic time to own stocks. People were very emotional and that I talked to, and, I tried to talk some of them into not doing what they were going to do, but they were going to do it. Um, whatever it takes to calm yourself emotionally. But I do think, again, if you have good companies and then you can look at your portfolio and say, hey, this utility, it's not going out of business. We know this, right? I mean, things are going to have to get much worse. And if that is the case, then just selling at this low point is not going to help me.
right, right.
And, I mean, in 2008, right, that was some pretty horrible leverage that was just coming crashing down on the whole system. And it became very obvious that no one really either knew what was up or didn't really have the courage to tell anybody that what was up. I mean, The Big Short is a really interesting movie.
Yes, it is. Yes, it is.
Good actors, but I think they did capture it at that point. But again, even at that point, there were still, I think, companies out there you could look at and say things are bad, but these things are going to still be around.
Now, did your companies you were invested in at that time, did they continue to pay dividends even during that 2008?
Well, the utilities that I recommended, there were just two of them that actually wound up cutting dividends because they had operations outside of the regulated utility area. So the utility sector as a whole just continued to pay dividends and increase them. Actually, most of them increased it. So that's a sector that is pretty resilient. We always have to buy whatever electricity, gas, water, electric utilities, particularly with all the artificial intelligence demand, and so they're in the middle of a big investment boom. Um,
So Roger, so that's no, so you actually, yeah, that's
yeah.
a perfect transition because what I
Okay.
want to do next is I want Nate to talk about what he's doing with his AI Copilot, and then I want to circle back around and talk about investing in energy, utilities, and AI infrastructure. But Nate, why don't you take that and just tell us what you're doing with Captain? Is that how you pronounce it?
Yeah, yeah,
Yeah,
exactly.
yeah. Just tell us about that for a little bit.
Yeah, so the general thing is I'm helping basically small and medium sized businesses in the U.S. and in Taiwan since I'm living there with my fiance to basically embrace this AI revolution that we're seeing, and then get their hands dirty a little bit and realize what it can do and what it can't do. And so it's really involving incremental steps and implementing it in small doses and seeing where it can actually be useful and reliable. And the whole idea with Captain is kind of it's more of a framework, which is a lot of the issues with these AI tools is, and anyone who's used ChatGPT, for example, for a while knows that they can kind of kiss your butt and tell you that you're, the hottest new thing. And so they're not really necessarily aware of where you're trying to go, and they can't. They're very limited in terms of giving you like strategic advice. You can use them to, sift through some data for you to find things way faster than if you were looking for them manually. But if you want to have a better idea of if you want your systems to have a sense of where you're going and where you've been and have that context to sort of self-regulate or help you figure out when you're drifting off course,
Hmm.
we're not really there yet. And so that's what Captain's, developing towards is like basically giving AI the ability to know where you're going and where you've been a little better and to sort of keep you on track so that you're not just, every time you're going and opening it up, it's not just a totally brand new conversation without the context of where you've been and where you're going, and also so that it's not letting you sort of totally delude yourself into thinking you can do something crazy that you can't do, or that you're doing the right thing when you're completely off course.
Yeah, so it's not just telling you what it thinks you want to hear, but
Yeah,
you're actually trying to develop a system that becomes, a more meaningful and more honest research assistant tool partner. I'm not sure what the right terminology would be, but some combination of those things, but it's more honest and therefore more useful in helping you make decisions, especially when you're making decisions about strategy, right? And where you're going to put as a business owner, where you're going to put your resources to try and move your vision forward. So am I getting that
yeah,
more or less right?
yeah. That's exactly it. So
Okay.
there's one business owner I'm helping who really wanted to speed up a lot of their data cleaning. And they get all this data with all kinds of horrible logical errors, and it takes their data cleaning team like an entire week to go through these multi 10,000 row data sheets, just Excel spreadsheets basically. And he was kind of hoping he could wave a magic wand and AI would solve the whole thing. But really, the way that I set it up is just for the AI to be really honest and basically fall back when it can't get it right, not be overconfident, make it very clear when it can't get the right answer, and just make it more obvious when you know if you would have gone with the AI and trusted it completely, you would have been completely ruined.
Yeah,
So
yeah.
it's that kind of principle and putting it into different tools and making sure that there's that sort of philosophy behind it.
Yeah, well, that's cool. So then and in that guy's case, right? Then was the AI able to help reduce that time? But then flag issues were like, well, this actually you need to look at this and make a decision. So they still had to spend some hands-on time with it, but it reduced that overall. Would that be right?
Yeah, exactly. I mean,
Yeah,
I
cool.
was working with the employees a lot, and I think they were really nervous that the tool I was making was going to replace them, frankly. And I think
Sure.
everyone's kind of spooked about AI being this huge moment that's going to wipe out everyone's work. But I think as we developed the tool, it became more obvious that this is not going to be able to replace you. It's going to make it a little less tedious because it can sort of flag different types of errors and whatnot. But it really can't be trusted to replace people's actual judgment. And so it has to flag things for human review. It has to give all sorts of fail safes and fallbacks. But it does still speed things up, and it makes it so that it's not quite so mentally taxing where you're just suddenly facing this like 10,000 row Excel spreadsheet. You're like, what's going on with this thing?
Yeah, well, that's cool, right? Because the way that I've been using it, right, is it reduces my amount of busy work, but I can see too, even just in the last couple of months and trying to sort of learn it and use it more for things and figure out, okay, how do I, how do I try to get it not to just be giving me so much fluff and be a little bit
Yeah.
more right, and also how to ask questions to get what I want, because it can be very literal, and it's like, oh, well, all right, I have to ask that question in a different way to get what I'm trying to get out of it. But in this case, right, but it doesn't, but I can already see like, oh, this isn't going to replace human decision making. It just isn't, at least not anytime soon or where it's at now. But if it can reduce that busy work, so right, if they've got a 10,000 line thing and it reduces that to, all right, you've got 1,000 or 500 lines now that you need to look at and really give some more attention to, that's huge. And then it just lets those people now spend that time more productively instead of just in sort of mind-numbing busy work. So I think that's cool. Yeah.
Yeah,
Awesome.
yeah, exactly. And I was someone who was really kind of gloomy about, what AI was going to do to everyone's work and, just trying to imagine. But it was also abstract. So it's kind of similar with, I guess, investing maybe, where if you just get your hands dirty and see what it's like and use it a little bit, you'll probably pretty quickly figure out what it can do and what it can't do. I
Yeah.
encourage everyone to do that.
Yeah, me too. I would agree with that completely. So then let's kind of wrap up with talking about why you like utilities and energy investing, Roger. And then also, I know you've mentioned there's a lot of talk, obviously, about investing in AI software, but you're actually pretty bullish on AI infrastructure. So talk about the difference there. And I'm assuming that kind of sort of fits in with the idea in a general sense of utilities investing. So kind of talk about those things, why you like those, how those fit together, that sort of thing.
Yeah, absolutely. Utilities, okay. So you have right now, or historically, you have they have a history of paying dividends. So I like that. They have a history of being very resilient. We've talked about that, in various downturns, particularly in 2008, probably the worst thing we've seen recently. We'll probably see something like that again. So resilience. But I think what makes them very exciting now for people is that they're investing to grow. And in fact, demand for electricity is growing in real time at the fastest rates since the 50s. You're seeing some companies report that their commercial sales, which includes data centers primarily right now, artificial intelligence enabled data centers, those are using a lot of energy. It's not the only,
Yeah.
and it's actually not the only thing we're seeing. I mean, we are seeing a lot of businesses reshore to the United States. The tariffs and so forth, I think probably fear of tariffs more than anything else. But this was happening before because companies wanted to bring their supply chains back to the US. So, or at least diversify them because of what happened during COVID, right? That
Yeah,
was
right.
revealed. So it's very exciting that these companies are actually now, that I've covered all this time, are now actually investing in their systems, in upgrading the power grid, something we all take advantage of. We take for granted as well. So you have basically companies that are growing earnings at very steady rates that were 2 or 3 times what they were growing them 10 years ago. And they're increasing their dividends at that rate. And I'm really paying a lot of attention right now to seeing how they're following through on these things. But it's right now a very attractive driver for capital growth as well as for dividend growth and so on. So that's kind of the utility story. I mean, with energy, I think we're in an all the above world where we need a lot of different energy resources. The drive towards cleaner, cheaper, more abundant, safer continues, and technology is like far better than, I mean, we've had some real major steps forward, particularly with things like solar energy or battery storage or wind power. And we're seeing a massive investment boom in these areas. So it's kind of a bullish theme for an industry that historically has been just you think of it as just being very reliable, slow growing, dividend paying, but now it's much more robust.
It's kind of dowdy almost, right? Utilities. You just think of them as they're not sexy or exciting.
Yeah.
But at the same time, they're just kind of always there doing their thing because like you said, we need them. Right? I mean, the demand for utilities is going up now because of things going on in society and with technology as a whole, but it never really drops precipitously.
Right.
Right?
No, even in periods where you've seen a big downturn like 2008.
Yeah. Well, right, because we all, like you've said, right, we all need water. We still need to heat our homes. We need, electricity for, our computers and our TVs and, cars now. So Roger, in the past, you used to include communications like the telephone companies in your utilities mix. It almost sounds to me like, as you're thinking of those a little bit differently now because of what's going on with their realities.
Yeah.
But now you could almost maybe include AI infrastructure in that, because in order to do all of the processing that's required for AI that more and more people are using every day, then you've got to have that infrastructure there to power all that. And so then that becomes almost like another utility. Is that how you think of it?
I think that's absolutely right. I mean, and particularly now there's so much demand. And there was a period there where data centers maybe were overbuilt a little bit, but even then, revenues were still fairly stable, kind of utility like. So I think that is a good point. A lot of the telecom companies around the world, they actually own data centers and they have a big operations in Japan. I mean, in the US, it has not been so much the case. It's been more like, the Amazons and those types of companies own them. But there are ways that investors can get involved. There's a company called American Tower, which is actually wireless towers. That's been their primary business, but they bought a data center company a few years ago, CoreSite, and now that's the part of their business that's really growing.
Yeah.
And so that's one reason I kind of favor and talk a little bit more about the utilities angle on the AI as being kind of the picks and shovels of the AI gold rush. I think it's a tremendous and fast growing area, and definitely the infrastructure is utility like. And yeah, that is something I look for. What are the kinds of things out there that have those utility kind of characteristics that maybe people haven't recognized yet?
Yeah. No, that's great. I like it. So if people wanted to reach out to you, Nate, where can they find you?
They can find me. I guess I have a Substack too. It's a little bit dormant, but it's N-powered. And so that's the letter N and then power and then ED. And that's the whole idea of, AI should be used to make things better for us, and we should all be empowered by it rather than, replaced by it or whatever else.
Okay. And Roger, should people, I actually would encourage everyone to sign up for your newsletter through your Substack, Dividends with Roger Conrad. Is there someplace else they should go to, or start there? Because you're putting out good information there, and all these kind of things we've talked about and in more detail. And I know we didn't talk about REITs at all today. We just didn't have time for that. But I know you've talked about that in your newsletter. So should they go there, or is there someplace else?
I think, just to keep it simple, Dividends with Roger Conrad. That's it's a free publication. I do it once a week. It comes out on Sundays. We do have a paid version of that, which will have a lot more hands-on kind of thing, more portfolios, more stocks and everything. I also have a company called Capitalist Times, and it has a publication. We talked a lot about utilities. It has a thing called Conrad's Utility Investor. So if you really like utilities and you want to find out more about that, that's a good place to go. But check out Substack, and that's risk-free, and you can see if you like the things I write about.
Yeah, great. So I will put links for both those in the show notes. And thank you both so much for coming on. I think it's been a really interesting conversation. I think it's really cool what you're doing, Nate, with the AI stuff. And Roger, of course, you've been doing this for a long time and helped a lot of people grow a lot of wealth. So, again, I encourage everybody to check out both your Substacks, those newsletters. And thanks again for coming on.
Hey, thanks for having us. Really appreciate it.
Thanks, Dominic. It's awesome.
Thank you for listening to this episode of the FI for Kids podcast. Please support the show by hitting subscribe and receive new episodes every Thursday. The intro and exit music this episode are courtesy of Douglas Cameron. As always, you can find links to the FI for Kids music in the show notes. Thanks again, and we'll talk next week.
You're about the horizon. I can't reach you, you're so far away. And if I run to the place I want you to stay, you'd be gone. I've been left wondering why you moved on, and why you never said goodbye. I can't I guess it's time for us to retire. I can't wait.